Welcome to Market Monday from the investment team and the trust department at the First National Bank. We'll start off with the economy and move into what's happening in stock markets and interest rate markets, closing out with implications for portfolios and overall market views and economic views. So starting things off, there's not a whole lot of data coming over the next couple of weeks, but what is coming contains some pretty important data. So let's talk about it. Tomorrow we get wholesale inventories, which are expected to show a climb of 0.7%, which is up an acceleration of climbing inventories from the prior 0.3% reading, in the last time this was released. And when that happens, when inventories at wholesalers are building up, what that suggests is inventories at retailers are also building up, or at least retailers are seeing less forecasted demand. Therefore, they're buying less from the wholesaler. And the way supply chains work, they go in stages. Wholesalers have to maintain a certain number of inventory based on their forecasts, and in order to exceed, if demand from the retailers comes in stronger than expected, that they can fill those orders, not experience things like stockouts, which is unavailable inventory. So there tends to be a cushion in wholesale inventories. When they're climbing, that means that existing inventories are not being drawn down quickly enough. And that's a sign that maybe the economy may be on the verge of shrinking or already shrinking. Retail inventories are expected to come in at 0.3% versus a 0.1% growth over the last period. That also suggests that retailers are seeing inventory sitting on their shelves. That's costly. They pay for that in terms of stocking things. It costs money to keep things on the floors. So that means consumers are buying less and retailers are incurring more costs. The inventories are incurring costs at wholesalers and so on up the supply chain. And the producers have to keep producing, so potentially there's excess inventory being created, all of which potentially leads to lower prices down the line, which is potentially a good thing, but also slowing economic growth, which is not a good thing. So we're paying attention to this. Consumer demand is 2/3 or more of GDP growth, and if we're seeing demand conditions through supply chains start to show signs that that's stalling, we need to take note of that. So consumer confidence number, that one's expected to show a precipitous drop from 92.9 to 87.6. Again, that suggests that there's a souring mood about what the future looks like at the consumer level, and it's worth noting given what consumer spending is as a percentage of GDP. We get GDP, the annualized quarter-on-quarter number, which is expected to come in at a 0.4%, which is sharply lower than the 2.4 it was in Q4 of last year. And what this means is, let's talk about what this means actually. Analyst expectations, sometimes it behooves us to look under the hood of what consensus actually means. So if we look at the consensus expectations for that, you can see that it ranges from all the way down to negative 1.5 up to 1.7% of quarterly growth. This means that, in the best estimates and the best models that firms and major economists have, it's all over the place. Nobody has a really clear agreement as to what they think is happening, and that means that when this number is released, it's less likely to move markets because there isn't any kind of tight agreement, there isn't any kind of high conviction trade on one way or the other. Nobody's in agreement on that. And that number suggests also that nobody really knows anything. If that was tightly clustered together, it would be a lot stronger of a forecast, but it's not. Looking into the price, the core PCE price index, that's expected to show a climb from 2.6 to 3.0, and that's a problem because if you've got economic growth at only 0.4% and you've got prices going by 3, the real problem is not slowing economic growth. The real problem is inflation, and the two things are really linked. This presents a unique quandary to the Federal Reserve officials. They've been bandying about in financial media anyway the term stagflation, and let's talk about what that means. That is a situation, and it's rare, where you have sharply rising prices at the same time you have either falling economic growth or negative economic growth. In other words, an actual shrinking of the economy, and that's the more commonly accepted version of that. And it really hampers what the Fed or any other central bank can do in response to any conditions, because all of the major policy tools that impact inflation also impact the economy, and all of the major tools that impact the economy also impact inflation. There's a very strong relationship between the two of those things. And to illustrate this, whenever the Fed, let's say, is going in to ease monetary policy, in other words, lower rates, that's designed to stimulate economic growth, but it also stimulates prices. So in effect, you stimulate the economic growth, but you also pour gas on a fire and add to inflationary pressure as well. On the other hand, to tighten monetary policy or hike rates, that has a negative impact on GDP growth. It puts the brakes on it, also putting the brakes on inflation at the same time. So in this type of environment that we appear to be in now, we don't know what they're going to do. They don't have very many traditional policy tools, so they're going to have to get creative. And we're going to be watching, because the next real major data point coming is going to be, next week, where we get their rate decision, and that's expected to come in unchanged. No news there. But what's going to be extremely important is what they say in the press release and later on in the actual press conference. They're going to be asked about this. What policy tools do you think you're going to use, given that we've got high inflation and lowering, slowing, potentially even turning negative economic growth on the horizon? And how they respond is going to be very much market moving. We need to be paying attention that day. That's at 2 o'clock on the 7th. We get inventory information again. Coming back to it, though, before the Fed, we're going to get the non-farm payrolls number. That was expected to come in at 130,000 jobs versus a prior 228. It's worth noting that this number consistently has been forecasted in that 100, 200,000 range, and consistently come in much higher than that over time. We think that kind of a pressure is going to change, and potentially with the signs of slowing in the economy, we might see these numbers being more accurate going forward. While we're not expecting major job losses and we're not expecting a major recession, we are expecting at least a deceleration in growth in the economy, or a mild recession, and that would indicate that these numbers about non-farm payrolls are going to have to come down. But closing it out, the real thing over the next couple of weeks is what the Fed says they're going to do when they're in that press conference, or read the press release. When we look at the market over recent history, it was really nice throughout 2024 until we hit this peak, right at the end of the year, and then into the beginning of this year, we can't get above this level. And then we have these violent churning drops, lots of volatility, which is, related to uncertainty in global trade. The whole system is different now. Between that, potentially slowdowns in the economy, high prices, there are a lot of things on investors' mind that just kind of came to a head starting in February and went through the month of March for the most part. And it does appear that we found some at least short-term footing in the market. So for a good bit of this crisis that was unfolding over the last couple of months, we were cautious, and we were advising just sit out and watch what happens, because no one knows how deep this rabbit hole goes. This change in the configuration of trade alliances and conditions is as important as what happened in 1945 at the end of World War II, when the world was structured in a new way. And so we didn't know what it was going to take for markets to become equilibrated and accustomed to what the new reality looks like. It appears to us that they're starting to get a clearer idea of what this world looks like, and that investors are in fact stepping in now. And we can say that with pretty high confidence. This indicator down here is one of the ones we use as a rule of thumb for gauging volatility. It's called the average true range. And in this case, I'm taking a 5-day period, so 5 trading days, 1 week. And when we see this thing spike, that's the difference between the high and the low, and it's the average of it over that week. And we got to really, really elevated levels on April 9th, and now it's been trickling down. And you might ask, why does that happen? What happened? We don't know what the new trade situation looks like. The news that's coming in is actually really pretty bad across most of these fronts. We're seeing high inflation. We're seeing tariffs news all over the place. We're seeing shrinking economy news all over the place. So why would the markets be starting to go up? And the answer is, uncertainty. So above all else, the market really dislikes uncertainty. And when things are unknown, that's when you see these violent churns, and there's really no one there to take a position to tighten up the market, for lack of a better way of saying that. Now, as the news starts coming out, despite how bad it is, you see this volatility really sharply declining, and the markets concurrently starting to move up, and the gyrations are a lot smaller. There's less panic, even though the news is bad. And that's the key. Markets don't necessarily need good news to go up. They just need a lot less uncertainty. When things are uncertain, there's panic. Blood in the streets is the old adage about that. And, we can look to recent history for that. Look at 2020 when COVID happened and there was just this big paradigm shift that had to be processed really quickly. Markets were plunging during that time until we started to get trickles of news. And the trickles of news were really bad. They were about fatalities. They were about rates of spread of this virus, how infectious it was, how deadly it was, and all of these things. Yet the market started to find footing and come up pretty sharply as soon as we got a clearer and clearer picture. We knew it was not a really nice world at the time, but at least we knew what it looked like and we knew how to deploy capital. And it's the same situation here. There is less uncertainty regarding how the world is going to look than there was a month or 2 months ago. We don't have certainty, though, and volatility could return at any time depending on new developments in what turns out to be an historic and ongoing saga. So coming into the yield curve in treasuries, this is really interesting. So this dotted line here is where we began the year in terms of interest rates. So, we had a 20-year that was like 4.86. We had a 10-year that was like 4.6. And this is really, a big difference from where rates are now. If you look, 20 years, we're at, what is that, about 4.75. We're at 4.26 in the 10-year. And we've seen this shrinking at the low end of the yield curve. What does this mean? Well, when the yield curve at the shorter end is going down, that's suggestive of, potentially weakened economic conditions over this period. A lower cost of capital is expected over this period. So inflation is expected to come down over this period somewhat, although not, noticing where these rates are, not anywhere near the zero that they were in prior years. This does suggest weakening economic conditions in the shorter run, although look, the longer end of the curve is actually now moving up from a month ago. And so when we say that, why would the yield curve be going up on the long end? And there are some interesting articles out there that suggest that investors, foreign investors, are pulling away from their holdings in U.S. Treasuries. That could be the case. It could also be the case that long-term inflation expectations are being reset to a much higher level than they were. Inflation risk really being the only premium in here. And the U.S. Treasury is not considered to contain any default risk. So these rates suggest, short-term economic pain, and then a longer-term return to growth that is at a higher level of inflation than we've been accustomed to for many years. Corporate yield curve tells us something a little different, though. As we start to look out on this curve, yes, it's down a little bit from here up until the 20-year mark, but then it's starting to get above what it was in recent months, and there's been a pretty sharp move up. What this is reflective of is the other type of risk that could be attributed to a fixed income instrument yield, and that is default risk premium. So there's, with the Treasury bond, there's only the inflation risk premium. That tends to just augur whatever the large investors think inflation is going to be over a period. Whereas corporate bonds include both that and a potential estimate of, hey, this company might go bankrupt at some point. We need to price in that risk in terms of the yield, which is why corporate bonds yield more than government bonds. Now, the spike here in terms of these yields going higher at the longer end suggests that investors are seeing rising credit risk, probably as a result of the trade frictions, probably as a result of a persistently higher inflationary environment that's expected, but no one actually is going to know why. These are just speculative things. But it does suggest to us, yes, this default risk premium is going up. That means investors are handicapping for potential defaults, and that suggests, again, potentially slowing in the economy, certainly of big change in conditions on the competitive level. And we think that's true, actually. So let's consider this. Years ago, when we were in the globalist era, we had a lot of cooperation. It was disinflationary. Everyone could focus on what they did best and sell and trade with each other to get what we needed. And prices, that kept prices low. And that also kept competitive conditions relatively even. and that allowed for a rising tide lifts all ships kind of market. When the cost of capital becomes volatile, trade frictions are there, that are at the political level, and you've got rising and volatile prices, and you've got consumer demand fluctuations based on all of this other uncertainty. You have an environment where, a lot of analysts, ourselves included, are calling for lower average equity returns in the market, average being the key. At the margins, any individual company is going to do really well or really poorly under these kind of conditions. If a company can execute with their finance team, with their product development team, with their supply chain and their marketing and strategic leadership, if all those things align, a firm is going to greatly outperform the ones that can't do those things. So in this market, while the average will be a good bit lower than what we've become accustomed to in the S&P 500, we are expecting individual results at the company level to be widely dispersed and there to be pretty massive opportunities. You just have to be able to, find those companies that have advantages, and then be courageous in executing on those. So what we see going forward, and this market tends to bear us out, is conditions are going to be that way for many years, and it's going to favor an active style of management over passive. So that's kind of what we're looking at here in forecasting. But to come back to it all, this was scary, and we actually got quite a few phone calls and we had quite a few meetings to keep people safe. The biggest mistakes that investors can make is selling into panics. It's typically going to happen somewhere around here. We don't want to be doing that. And in this case, we also didn't want to necessarily be buying here either, because we didn't know how deep the rabbit hole went. So we advised kind of a wait and see. Now that these average true ranges are coming in and, the volatility appears to be receding, we think, maybe it's time to become more optimistic and say, all right, the market views are solidifying. It's become safe to really position again. So we think that's the case. And when we look over long terms, we had 2008. Market was on the verge of collapse, the financial system itself. 2020 was a complete shutdown in global trade, not just simply a reordering of it. And, look what happened there. We had a bear market in 2022, and we had some downdrafts in between, regular downdrafts. But this is actually pulling up, and we're taking a longer view. If you started back here 20 years ago, you're still up more than 5 times on your investment. So, we want to be in it for the long haul. We want to make our strategies long-term in nature and dedicated toward reducing risk in volatile markets, which we've done. And, adhering to the long-term financial plan and investment plan is what we need to be focused on, not on whatever's happening in the short term in markets. And, if you need help with that, you want to talk about what's going on in the economy, let's talk about what's going on in the markets, your particular portfolio or your financial goals versus realities. We love to talk about this stuff. Feel free to reach out to us. Hope you found this video useful. Thank you and have a great day.